The housing market, once a booming powerhouse, is now teetering on the edge of uncertainty. After years of skyrocketing prices and record breaking sales, cracks are beginning to appear. Today, we delve into a topic that has homeowners and investors alike on the edge of their seats. Could we be facing a housing crash in late 2023? Join us as we analyze the data, consult the experts, and uncover the warning signs that indicate trouble may be lurking around the corner. The housing market has experienced a slowdown recently, mainly due to rising mortgage interest rates. Since March 2022, rates have been on an upward trajectory, reaching a 20-year high of 7% in October 2022, as you can see here in the St. Louis Fed's 30-year mortgage chart. Current mortgage rates are hovering around the mid 6% range, with the Federal Reserve expecting to further raise interest rates 50 more basis points before the end of the quarter.
We see the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. As noted in the FOMC's Summary of Economic Projections, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year.
These rate increases, coupled with a sharp downturn in buyer demand, have led to a rapid decline in home prices. You can see that better visualized on this chart, which shows how a rise in interest rates, the red line, has helped cool down home prices, which are shown here in blue. Now, according to experts, the rapid increase in home prices that we saw during the pandemic does not necessarily indicate a housing bubble. Other fundamental factors need to be considered. Factors such as shifts in disposable income, partly fueled by stimulus checks and a pause in student loans, rising costs of construction materials, and supply disruptions contribute to sustained real price gains. Len Kiefer, deputy chief economist at Freddie Mac, disagrees with the notion of a housing bubble. He believes that the increase in housing prices was primarily driven by record low mortgage rates and a fundamental shift in housing demand. However, it's worth noting that some homeowners who bought their homes during or before the pandemic are now seeing a decline in their home values. Keith Gumbinger, vice president of the mortgage website HSH.com, explains that while this may result in a paper loss, it is not necessarily an actual loss.
We are no longer in this house price boom where you have many buyers bidding up the prices. Now it's a little bit more that sellers are, sometimes their homes are sitting on the market. Sometimes they're having trouble selling. And so we are seeing a slight national decline in home prices, but it's pretty muted so far.
To understand the current situation better, let's compare it to the 2008 housing market crash. One significant difference is that lending standards are much tighter now, reducing the likelihood of default. Unlike the pre-crisis period, many borrowers now have fixed rate mortgages. So even though mortgage rates have doubled, current homeowners will not see a change in their monthly payment, meaning that we will avoid the wave of foreclosures that we saw back in 2008 and 2009. Another key difference is the higher number of homeowners with equity in their homes today. In late 2009, nearly 1/3 of U.S. homeowners were underwater, owing more on their mortgages than their houses were worth. However, recent data shows that nearly half of mortgaged residential homes in the United States are considered equity rich, with homeowners' equity to real estate property value reaching a whopping $29.31 trillion in 2022, up from a financial crisis low of $8.35 trillion in 2011. This increased equity can help homeowners weather a downturn. Now let's explore some warning signs that could potentially dampen the housing market. The combination of high mortgage rates, inflated home values, lower buyer demand, and a potential recession creates a challenging year ahead for the housing market. Affordability is at a record low, making it difficult for potential buyers to enter the market.
Well, affordability is still not great at all. And in fact, it's getting a little worse. We got the S&P.
Additionally, those who bought homes in the past 2 years with ultra low mortgage rates are unlikely to move, further limiting inventory. As economists predict a potential recession in the coming years, the housing market braces for impact. High mortgage rates, inflated home values, lower buyer demand combined with a recession could create a challenging environment for housing. Affordability concerns and the fear of home prices declining may discourage potential buyers from entering the market. And if a recession occurs, Job losses and reduced consumer spending could further dampen the housing market's resilience.